Hi, folks. Welcome to the Weekend Investing Daily Bite of 4th of December. The dullness in the market continues. The market is in a complete, disinterested state of its being. No sector, no part of the market is willing to really go up. The rupee being at 90 or around that has taken the narrative completely. There is a lot of rumors that the US India tariff deal is on the back burner now, especially because President Putin is coming to India and some big deals are likely to be signed with him, and that is going to further antagonize the US team. There is little in terms of cues that are there in the market. It is not that emerging markets are not getting flows. It's just that India is suddenly slumping very badly on all parameters, whether it is FDI, whether it is FII flow, whether it is even the overseas NRI uh, flows that come into our country. All that has suddenly not kept up with the percentage gain that usually is there. So suddenly, when you will find that there is a lull in terms of inflows, but the outflows continue because you have to buy crude oil and Indians love to buy gold. So the trade deficit continues to happen and inflows are impacted. That of course will create pressure on the rupee, and that's what's causing some loss of positive narrative in the markets. In the let's first see some charts and then we'll talk about this. Disclaimer as always, do read the disclaimer fully, understand it, and then move forward in the video. The Nifty, while it moved up 0.18%, but overall the market didn't seem like moving up. It was very, very dull across the board. And you can see only very small gain has come through in Nifty Junior after a big beating on the previous session, 0.23% up. Mid caps did not even do that, 0.04% negative. Small caps continue to fall at 0.24%. And actually speaking, we are in a very critical zone on the small cap space. This 16,500 odd level has been a support for many times. The market has come down, and if this breaks, uh, at least the confidence in the small cap space will go away for some time. Nifty Bank also completely flat, minus 0.1%. So market is looking for something to tag along, to some cue to hold on to, but is not available right now. Gold also slipping 0.26%, 12,877. Silver also dropping 1.81% to 1,76,000. So, and USD INR retracing a bit from 90.43 to 89.94. We've shown in some studies earlier that whenever the USD INR starts to move, on an average, it moves about 18%. This time we have moved about 8%. Whether we will go another 10% or not is just a guess that we can have. But if it does, we will be sitting in a 95 to 100 zone sometime in second half of 2026, according to that historical calculation. Advanced decline ratio, the market started to have gaining advances in the first few hours, but then gave it up. But by the end of the day, it was nearly even, 228 advances to 272 declines. Nifty heat map is reasonably green today after the complete washout yesterday. So IT stocks continue to run up on the expectation that rupee continues to fall. Some banking and finance space perked up. Energy stocks, ONGC, Coal India, Power Grid did well. Reliance minus 0.21%, but Reliance is looking not so bad. And Reliance is also starting out the IPO process for Reliance Jio. That should give it a good boost in coming times. Mahindra doing all right. Bajaj Auto, ITC, Sun Pharma, Bharti Airtel, JSW Steel, and Indigo down nearly 3% on the uh, fiasco that is happening at our airports. That probably is something that a monopolistic situation has arisen where most of the flights are being operated by Indigo and Air India only. So Indigo is the only private, or you can say Air India is also private now with the Tatas. But on most sectors there is monopoly of one carrier or perhaps a duopoly, and that is causing a lot of issues in the airline space, I think. Nifty Next 50 heat map had some gainers in LTIM, Naukri, HAL, ABB, Motherson, Siemens, Britannia, Torrent Pharma, but power stocks lost. Adani Power, Enrin, JSW Energy. Uh, you had Hinzing go down, IOC, BPCL went down, Bajaj Holdings went down. Mixed bag from a perspective of Nifty Next 50. In the mover of the day segment, Hind Copper has done well, plus 7.83%. Copper prices are going up. Now, you are seeing that the move that started in precious metals is now gradually percolating down into other metal regions. So, copper is also now going up, and Hindustan Copper is going up because of that, as well as because of silver. Sectoral trends, mixed bag. Only IT stocks are gaining 1.4% plus on IT, and some comeback after yesterday's drubbing in defense, real estate, FMCG, and CPSCs. Most likely, this is a reactionary gain in these four, and it may continue on the downside if the market continues on the downside. Tourism stocks down 1%, media stocks 1.45%, energy stocks 0.34%. So not much action right there. IT stocks, of course, doing well. Coforge, Persistent, LTI, Mindtree, Emphasis, and TCS all doing well. Even if we were to have a 10% move overall in rupee in USD INR, that's a big margin plus for the IT stocks. Media continues to go down. PVR, Tips, Network 18, Z Entertainment, and Saregama losing ground there. In the US markets in the previous session, you had Russell 2000 do very well at 1.8%, 1.9% in fact. Dow Jones up 0.86%, S&P 500 and Nasdaq also minor gains there. So US market is very, very strong. Bristol Myers Squibb, United Health, Accenture, Texas Instruments, and Tesla were the big gainers there. Some of these stocks could be a part of the weekend investing US stock strategy. So that is a disclaimer, and these are not recommendations. US markets actually have done reasonably well this year, while Indian markets have uh, basically gone flat. In the tweet of the day segment, a very nice tweet from at normal 2610. Um, this was about the Indian rupee. So what he says is that India wants foreign money, but only on its terms. And big capital, big global capital hates that uncertainty. India keeps spending more dollars than it earns. That is the core problem, and we are basically not addressing that problem. We import way more, especially oil and gold. And when the rupee weakens, our import bill explodes. But unlike China, this whole rupee strength becomes emotional, political, and nationalistic debate. In China, it is a pure economic management. Right now, of course, we cannot compare India and China also because China has a great trade surplus. Right now, the weird thing is that the dollar itself is weak globally. So dollar was declining versus other currencies, but Indian rupee is declining versus the dollar also. So Indian rupee versus other currencies is even a worse situation than rupee versus the dollar. So, you know, uh, what is happening is that US tariffs are hitting Indian exports. So FPI money is running away fast. FDI is also slowing. A lot of foreign investors have booked profit via IPOs, and that money is sitting outside. They're waiting for the rupee to correct as much as it will, and then they want to bring that money in. So the trade that was happening, which was China to India trade, that money was going to move from China to India, has actually moved from India to China or elsewhere. And gold and silver imports are shooting up because people are a bit scared. They buy gold when they don't trust the currency. ETFs also need to import real gold, so that adds to more pressure. Normally, capital flows cover India's huge trade deficits, but now flows are negative. So this entire NRI flow, the FDI flow, the FII flow, I think that all is causing no protection for the rupee. And a behavioral loop has been triggered where exporters are now waiting to get to for the rupee to get cheaper so that they can book their earnings from the dollars, and the importers are rushing to import because they fear higher costs later. So it becomes a self-fulfilling cycle unless the central bank steps in and yeah, sort of calms this out. um, of course, weak rupee has some great advantages for exports. exports become cheaper, remittances become stronger. But this loop that starts is something that needs to be stopped, or at least whatever has to happen should happen very very quickly. Government also loves a weak rupee because nominal GDP jumps. This is a very important point where tax collections start to look bigger and debt to GDP improves. But the bad side is imported inflation. Oil gets expensive, input costs rise, and the whole economy feels the pinch. So India wants foreign money, but only on its terms, and that is the problem, that we are not allowing. We For 2 years, 22, 23, we were allowing the rupee to not fall while all other currencies were falling against the dollar, and that has lumped up and now coming in as a one move. So our from as an investor, our move should be, how should I arrange my money, my skills and my assets, so that I'm not paying this invisible tax. So we are already paying direct income tax, we are paying indirect income tax, we are also paying for inflation, which is a hidden tax, and this is the fourth level of taxation, which is basically us getting cheaper in terms of our ability to buy global products and services that keeps going down with the rupee. So your purchasing power basically is falling, and you are paying this fourth tax as well. So you need to be set up for that. So how can be set up for that? You have to diversify into assets which are not rupee based or rupee denominated. So one of that key assets is gold, which is a globally priced asset. Another could be US stocks, which Indian investors are quite familiar with, and there could be many more. I mean, you could buy real estate outside India and all those kind of things, or you could just park money outside and look for gains on the dollar. Um, Another tweet was about capital gains. Sandeep Sabharwal says government can relax the capital gains tax. That will cause some inflows to come in. Um, and I totally agree with him that we've lost the plot in the sense that last year we increased the capital gains for L&T, for long term capital gains and short term capital gains. That while did not really make so much of a difference to what amount the government got from the markets, because the markets were anyways not doing so well. But the fact remains that it mentally creates a resistance in the mind of the foreign investor, wherein if they have 10 countries as options to go to, and one country says that no, no, I want more tax from you, then obviously that becomes a hurdle for them, and they'll go to somewhere else. Indian investors of course have no choice, so they will get stuck with Indian stocks and Indian taxation. But foreigners have a choice, and that is probably causing this resistance. I think the government must realize that for India to do well, the capital markets have to do very well. Like the new capital that comes to the market via IPOs, via FPOs, foreign portfolio investment, is all basically like grease for the economy. So the more grease you have, the smoother it will run, and the engine will keep running. And we also keep forgetting that we are at still a very nascent place where our households invest just a few percentage of their savings in the markets, and invest even more in insurance and even more in fixed deposits. So we need to encourage more companies to come to the markets, to list, to create a wider ecosystem for newer promoters to come, more paper to be available for subscription and for investment. And in our life cycle of this growth, it is too early to try and curb these activities with unnecessary resistances like SGT or higher capital gains, etc. So my sort of thoughts are that I'm hoping, and of course one can always hope, I don't know whether it happens or not, but in the coming budget they will uh, hopefully relook at the curbs for the capital markets, and perhaps relook at STT and capital gains tax a bit, and make sure that it these things are not the barrier for money coming into the markets. Is INR going to fall further? What does the data say? We will do a deep dive on data points in the next video. Do watch out for our next video later in the day. And for now, if you can join the Weekend Investing Community, there's a form link in the description. You can drop your email and you'll start getting premium market insights. If you like the video, do like and share this video. If you want to subscribe to our channel, that will be great. Please do subscribe to our channel. Thank you. Bye bye.